Welcome back to the deep dive. You know that feeling when you look at today's stock market record highs, all this euphoria around AI, certain valuations that just seem, well, impossible, and you feel that little historical chill?
It's the ghost of 1929 whispering, and I think today we're going to face it head on.
Exactly. We've gotten our hands on this really intensive analytical deep dive that asks a pretty chilling, straightforward question. Are we living through the run-up to a modern-day 1929?
Right. And the document draws some striking parallels between the market euphoria of the roaring 20s and, the highly valued global economy of 2025.
So our mission today is to move past the scary headlines.
Yeah, we're going to separate the historical risks, what was truly unique to the 1920s, from the persistent, fundamental dangers that might still threaten us today.
We want you, the listener, to walk away knowing exactly where the modern safety nets are and where our current system is still maybe surprisingly fragile.
So let's start with the trauma itself. We have to understand what actually killed the roaring 20s.
Yeah, you have to start there.
Well, the context is key. The late 1920s was this era of seemingly boundless prosperity and technological optimism, and yet it ended so abruptly with the panic of October 1929.
Which ushered in the Great Depression. The analysis points to two main drivers, right?
Two primary catastrophic drivers. First, rampant speculation, and second, massive credit expansion, what we today would just call leverage, or easy money.
So the whole financial system back then was built on this rickety foundation of borrowed hope.
It really was. And the analysis details just how toxic that blend became. People weren't just investing their savings.
No, they were taking out huge loans against the value of stocks they already owned just to buy more stocks.
Those were the notorious margin accounts. You'd put down a small percentage, maybe 10% in cash, and borrow the rest.
And the problem with that, as the document highlights, is that it completely disconnects the stock price from any real underlying business value.
Precisely. Prices were being driven up solely by new credit being taken out against paper profits. It was a financial pyramid built not on bricks, but on, I guess, expectations.
So the bubble wasn't just in a few hot sectors. The bubble was in the very mechanism of buying itself.
Yes. And what's truly fascinating is how the attempts to stabilize things actually made the crash worse. The Federal Reserve, they saw this frenzy of speculation, and they felt they had to intervene.
So they did what seemed logical. They raised interest rates.
They did. In August 1929, the Fed raised its refinancing rate to 6% to try and cool down the overheated U.S. market. On paper, that's the right move to curb speculation.
But this is where the global system of the time created a fatal trap. And the analysis really spends some time on this point.
It does, because you have to remember, 1929 operated under the gold standard. The U.S. dollar was rigidly tied to gold.
So when the U.S. raised its rate to 6%,
it instantly made U.S. debt and assets way more attractive globally. That high rate acted like a huge financial magnet,
pulling capital out of everywhere else and straight into America.
Exactly. Capital flight began, sucking crucial liquidity out of European economies, out of global trade networks that were already so fragile after World War I.
So the Fed tried to fix its own domestic speculation problem. But because of the gold standard, the shockwave just devastated the global economy.
It slowed down trade, it compounded debt problems overseas, and you combine that with all the internal U.S. problems, agricultural overproduction, falling commodity prices, shrinking demand, and you just have the perfect cocktail for failure.
Which led to the panic of October 1929.
The Dow Jones crashed by about 25% in just 5 trading days. It was the signal that started a global catastrophe. A chilling lesson in how fast sentiment and liquidity can just vanish.
Okay, so that's the trauma of the past. If we use that as our filter, what does the market mood in 2025 look like? Is it similar?
Well, we absolutely have euphoria today. The source material notes that despite all the geopolitical risks, inflation risks, major indices are at record highs.
I mean, the S&P 500 grew by, what, 14% since the start of the year?
An impressive 14%. That kind of momentum suggests really strong confidence.
And if 1929 was fueled by new technologies like radio and the automobile.
The modern engine is crystal clear. It's the hype around IT, and specifically artificial intelligence.
The parallel is almost too perfect.
It's striking. AI today is seen as this revolutionary, disruptive, limitless sector that justifies almost any valuation. The belief is that it'll transform productivity overnight.
That emotional belief in a guaranteed future, regardless of current earnings, that's the echo of the 1920s.
It is. The technology is different, but the mechanism of speculative excitement is basically identical.
And that kind of concentrated excitement is always risky. The analysis points out that the warnings, well, they're not whispers anymore.
Correct. We're seeing prominent bank executives publicly sounding the alarm about excessive valuations. The documented expectation among serious analysts suggests a market correction of, say, 10 to 15% is highly probable, not just possible.
And we're seeing that nervousness in the market's behavior. The recent sell-offs in tech, even if they're temporary, they show the anxiety is real.
And it's not just a U.S. thing. The analysis flags similar anxieties across the globe, with big concerns about real estate stability in both Asia and Europe. The fear of overvaluation seems to be universal.
So we have the historical echo, the euphoria, the concentrated investment, the warnings. But the real question is, can the structure of our system handle a shock today? How does the health of modern finance really compare to 1929?
Okay, so let's talk banks. This is probably the area of greatest improvement.
Or are they built differently?
Dramatically so. According to this analysis, the banking system in developed countries is just so much more robust and resilient, mainly because of all the regulation that followed the 2008 crisis.
I hear capital reserves, but break that down. What does that actually mean in practice for our listener?
It means the safety cushion is much, much thicker. Regulators demanded that banks hold substantially more capital against potential losses.
Okay.
And the analysis has compelling data from the Federal Reserve Board, the FRB, from their stress tests. They model these really harsh economic scenarios to see how banks would cope.
And the results?
The potential capital deficit banks might face in a worst-case scenario has fallen from around $260 billion down to about $160 billion. That is a massive verifiable reduction in systemic risk.
That sounds like a huge win. But if this system is so strong, why do we constantly hear about the next looming crisis? Where does the analysis see the gap between that strong capital and this persistent anxiety?
That's the right question to ask. The analysis points to two big vulnerabilities, even with all that capital. First, liquidity. The availability of free, easily accessible cash has actually gotten a little worse.
Wow.
The liquidity stress ratio is back to pre-pandemic levels. We're just holding less of that easy cash buffer than we were a few years ago.
So the banks have the money in reserve, in theory, but maybe not the fast cash they'd need for sudden panic.
That's one strain. The second is tied directly to the sharp rise in interest rates. Banks are holding these massive portfolios of old bonds they bought when interest rates were near zero.
And now that rates are high, those bonds are worth less.
Exactly. So the banks are carrying substantial unrealized paper losses on those portfolios.
Let's make that relatable. It's like owning a classic car you bought for $100,000 when the market was hot.
Yeah.
Now it's cooled, and everyone knows it's only worth $80,000. You haven't lost the $20,000 unless you sell, but you know your net worth is lower.
That is the perfect analogy. And those unrealized losses, they don't harm the bank unless they're forced to sell, but that weakness creates pressure. It restricts their flexibility.
Okay.
But the analysis always circles back to the biggest structural anchor, the one theme that really links 1929 and 2025, aggregate debt.
The overwhelming total.
Yes. The combined level of debt, sovereign government debt, corporate debt, household debt, is just huge. And that massive debt load creates a systemic vulnerability no matter how strong individual banks are.
So banks are stronger, but the debt carried by everyone else is the system's weak link. Let's pivot to the broader macro picture. What about jobs, prices, the human element?
Well, on unemployment, the picture is overwhelmingly positive. A key difference from the past. Unemployment remains comparatively low.
What are the 2025 numbers?
We're seeing U.S. unemployment at around 4.4%, and the Eurozone is near historic lows at about 6.3%.
Which is nothing compared to the 25 to 30% unemployment we saw during the Great Depression.
It's a completely different world. The labor market is simply not collapsing.
And what about inflation, the big enemy of the last few years?
Significant success there. Annual price growth in the U.S. and the Eurozone is back close to that 2 to 3% target range. But the analysis does point out that core inflation, which strips out volatile food and energy, is a bit more persistent.
And why does that core number matter so much?
Because it represents the underlying structural costs in things like services and wages. Its persistence suggests the inflation fight isn't totally over. The central banks need to see that core number come down consistently before they can declare victory.
Which brings us to central bank policy. In 1929, the Fed tightened too hard. How are regulators handling that tightrope walk today?
This is the critical juncture. And they are hyper-aware of the 1929 mistake. They're acting cautiously, trying to beat inflation without causing a recession by squeezing the economy too hard.
And we're already seeing the pivot in the data.
We are. The U.S. Fed has already cut rates twice in the fall of 2025, bringing the range down to 5 to 5.25%. And the ECB in Europe, they're holding at 4.5%, but are widely expected to soften their policies soon.
So the goal is to use high rates to win, but cut just fast enough to keep the whole indebted system from snapping.
Exactly. But on the fiscal side, government debt is still a huge issue. While emergency programs are gone and deficits are shrinking, the global deficit is still large, about 5% of GDP.
And that means future policymakers just have less firepower if another big crisis hits.
Far less.
Okay, so this brings us to the main event. What did the document conclude? Let's synthesize this. What are the 4 key similarities, the alarms that still echo 1929?
Okay, first, asset bubbles. A clear period of asset overvaluation driven by hype. Then, it was auto and radio.
Now, it's IT and AI. The mechanism is timeless.
Second, credit dependency. There is a massive debt burden across every sector. Back then, it was marginal loans driving speculation.
Now, it's the colossal aggregate debt of governments and corporations.
Third, monetary policy risk. The danger that high interest rates, designed to fight inflation, accidentally trigger a sharp recession. It's the same tightrope walk.
And 4,
Globalization. Economic problems are never local anymore. Tight global trade ensures rapid worldwide spread. Just like the gold standard spread the pain in 1929, the contagion risk is absolute.
So those are the threats. But the analysis really shines when it contrasts those with the fundamental differences, the safety nets we've built.
Yeah, and this is the most important part.
What's the single biggest institutional difference?
The existence of crisis protection systems that were just absent in 1929. The most powerful one is state deposit insurance.
Right. In 1929, if your bank failed, you were ruined. Instantly. Which triggered panic and bank runs.
Today, your deposits are insured. That neutralizes the single most catastrophic panic mechanism.
And unlike the hands-off approach of the 1920s, today's regulators are all about active intervention.
Absolutely. Today's governments and central banks are ready to act instantly, providing liquidity, coordinating relief, using fiscal stimulus. They are mandated to fight a downturn, not just watch it happen.
We also have those built-in stability mechanisms.
Yes, the crucial automatic stabilizers, things like unemployment benefits. They automatically cushion the blow of a downturn on people's incomes, which supports demand and softens any recession.
And our economy is just much more diversified now. It's not just factories and farms.
Precisely. The conclusion on the differences is clear. The modern system is just vastly better equipped with tools and experience to fight the consequences of a shock.
So what's the final word from the analysis? Is the ghost of 1929 a genuine threat?
The document asserts that a direct repeat of the 1929 scenario is highly unlikely. That crash was a unique cocktail of political error, rampant speculation, the rigid gold standard, and absolutely zero institutional safety nets.
So the system today is just better protected by design.
It is, but that doesn't eliminate the risks. The nature of the risks, asset bubbles, and debt, that's a constant feature of capitalism. Our major advantage today is having a powerful fire team, the central banks and governments, ready to intervene instantly.
And that brings us to our final provocative thought for you, the listener, to consider. We know we have these powerful tools that prevent a 1929-style collapse, but the persistent use of these tools, the constant liquidity injections, the years of ultra-low rates that fueled this debt, the ballooning government balance sheets might be creating entirely new, unknown systemic risks.
We've bought our stability using debt.
Exactly. So what is the long-term price of the stability we are purchasing through constant intervention? Are we just trading the acute, terrifying pain of 1929 for a chronic underlying weakness, a permanent debt anchor that might manifest in a way we haven't even predicted yet? That is the ultimate question that lies beyond the history books. Thanks for joining us for the deep dive.